Hey, today I want to discuss why Warren Buffett sold. Now, I want to get into why I think he sold based off of historical data, because this is coming from the guy who tells you to never bet against America and you buy good companies and hold. Those are direct quotes from Warren Buffett. And so he just sold half his stake in Apple for the first time ever. Um, he sold 49% of his tech stake, which means that he sold about 84 billion of Apple shares, and he now has $277 billion in cash. So if he has over a quarter of $1 trillion in cash, and by cash, when they say cash, they don't actually mean literal cash. They're talking about T-bills or treasuries, right, in general, the long end of the yield curve. And so when I've been talking about the yield curve and how these billionaires are inverting the yield curve, Warren Buffett is a part of who's inverting it. And what I mean by that is that in order for the yield curve to invert, the way it happens is people buy the 10 to 30-year treasuries or bonds, and then that makes the price go up and it makes the yield go down. And because the yield goes down, it goes below the short-term yields. So for example, a 2-year, and that makes it invert. Okay? And so his financial positioning reveals what he thinks is going to happen because he is quite literally betting against America right now, right? So he just sold for the first time ever, uh, at least a big position like this. And he has lived through 12 recessions, okay? So what I mean by that is this. If we go to the unemployment rate and we go to it here, there are 12 recessions here. The 2020, 2008, 2000, the 1990, 1991 recession, 1981, 1982 there is, and then the 1981, 74, 70, 61, 58, 54, and 49. So this is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 recessions. And you can see what's happening with the unemployment rate and what happens every single time this happens. It continues. So how bad is this? Well, the low of the cycle was 3.4 down here. 3.4. We're up at 4.3 right now for the unemployment rate. The low of the cycle here was 4.4. So by the time we were up to 5.3 or 5.4, where were we? May 2008. So this is a serious warning sign, and this is lagging economic indicators, right? And I've been talking about how the unemployment rate's going to go up and everything, but he has lived through 12 recessions, and none of them have concerned him. But he is concerned about something. So what is the only time, or what is the only thing that's happened uh, throughout his adult life for the first time ever? It's not a recession, because again, he has lived through 12 of them as the adult. He was born in 1930, okay? So even this one, he lived through as the adult, and he did have money at that time as well. What is the only thing that has happened now that has not happened before? It's this, a money supply contraction. Now, I'm gonna get into the timing and why it's very suspicious what he's doing with the timing of his Apple sales, okay? And he sold in the second quarter, and it was reported in their earnings report, Berkshire Hathaway. So we know that he dumped it last quarter. We don't know exactly when, but we know that he dumped it last quarter. And so we're going to get into the timing and why it's very weird, because if there's 12 recessions on this chart, right? There's 12 recessions here, and he is dumping right here on this chart, but he has never done it during any of these recessions. The black line here is the M2 growth rate year over year. You can see it's gone negative. This has only happened 4 times before on the chart, and they all resulted in depressions, not recessions. So if he's sat in the boat throughout the recessions, maybe he's trying to dodge a depression. I'm going to get into why. The last time we had this was in 1930 during the Great Depression. Before that, 1921 was also a depression. 1893 was also a depression. And 1878 was also a depression. And then we have a monetary contraction in 2023. There are 12 of these going back to the 1830s. Monetary contractions, they have all resulted in severe recessions or depressions, most of them depressions, okay? So, what I want to get into is a couple of things. Number one, Chapter 11 filings reached their highest level in more than a decade, but this time it's an uptrend. Back then it wasn't a downturn, as you can see. Warren Buffett, on October 16th, 2008, wrote, "Buy American, I am. The financial world is a mess, both in the US and abroad. Its problems, moreover, have been leaking into the general economy, and the leaks are now turning into a gusher. In the near term, unemployment will rise, business activity will falter, and headlines will continue to be scary. So, I've been buying American stocks." This is my personal account I'm talking about, in which I previously owned nothing but the United States government bonds. This description leaves aside my Berkshire Hathaway holdings, which are all committed to philanthropy. If prices keep looking attractive, my non-Berkshire net worth will soon be 100% in United States equities. Why? A simple rule dictates my buying. Be fearful when others are greedy, and be greedy when others are fearful. And most certainly, fear is now widespread, gripping even seasoned investors. To be sure, investors are right to be wary of highly leveraged entities or businesses in weak competitive positions. But fears regarding the long-term prosperity of the nation's many sound companies make no sense. These businesses will indeed suffer earnings hiccups, as they always have, but most major companies will be setting new profit records 5, 10, and 20 years from now. Let me be clear on one point. I can't predict the short-term movements of the stock market. I haven't the faintest idea as to whether stocks will be higher or lower a month from now or a year from now. What is likely, however, is that the market will move higher, perhaps substantially so, well before either sentiment or the economy turns up. So, if you wait for the robins, spring will be over. A little history here. During the Depression, the Dow hit its low at 41 on July 8th, 1932. Economic conditions, though, kept deteriorating until Franklin Roosevelt took office in March 1933. By that time, the market had already advanced 30%, and the total decline had already been 90%. Or think back to the early days of World War II, when things were going badly for the United States in Europe and the Pacific. The market hit bottom in April 1942, well before Allied fortunes turned. Again, in the early 1980s, the time to buy stocks was when inflation raged and the economy was in the tank. In short, bad news is an investor's best friend. It lets you buy a slice of America's future at a marked down price. Over the long term, the stock market news will be good. In the 20th century, the United States endured 2 world wars and other traumatic and expensive military conflicts, the Depression, a dozen or so recessions and financial panics, oil shocks, a flu pandemic or epidemic, and the resignation of a disgraced president. Yet the Dow rose from 66 to 11,497. You might think it would have been impossible for an investor to lose money during a century marked by such an extraordinary gain, but some investors did. The hapless ones bought stocks only when they felt comfort in doing so and then proceeded to sell when the headlines made them queasy. Today, people who hold cash equivalents feel comfortable. They shouldn't. They opted for a terrible long-term asset, one that pays virtually nothing and is certain to depreciate in value. Keep this sentence in mind. They have opted for a terrible long-term asset, one that pays virtually nothing and is certain to depreciate in value. Today, people who hold cash equivalents feel comfortable. They shouldn't. But he is holding cash right now. How do we know that? He has $277 billion in cash. Why? Why does he have this much in cash? And if you don't think this is a big deal, that's perfectly fine. But their cash pile is at a record high, and it's not looking good. I'll even bring out the picture. This is Berkshire Hathaway's cash and short-term investments in money markets, meaning the bond market. Look at their cash pile. What does he know? Well, Warren Buffett has talked about the Great Depression quite a bit, and he's talked about how because his parents lived through it, I mean, he was born in the Depression, but his parents lived through it, he was really, really spooked by it. Really, really spooked. He was not scared of recessions, but he's scared of depressions. So, if I know that there have been 4 depressions, but none of them have been in his lifetime as the adult, why did he just get out so big? Why is he now betting against America, which he tells you to never do? Never bet against America. I'll even bring up these quotes, okay? Warren Buffett, never bet against America. It's in multiple YouTube videos. I'm not really gonna look at this, but he talks about never bet against America, right? He loves Apple. He has nothing against the US. He thinks the US is going to win long term. But it doesn't matter because he got out. Now you might say, why did he not sell 100% of his Apple shares then? Well, multiple reasons. Number one, he cares about America. If he sells everything at once, it's gonna look really bad. I mean, it already looks bad, but imagine how bad that would look. That would literally confirm to the world that, okay, guys, we're going into a Great Depression. It's already somewhat confirming it by this large sell. But think about it. And also, number two, it would really hurt Apple. And it would induce panic. And when you're a big player, you're not playing the game yourself. You need someone to sell into. You need liquidity. You need someone to absorb your sell, right? With a buy. And so that's why if you Google Elon Musk's net worth and it says 250 billion, if you try to sell it all at once, he wouldn't get that much out. Maybe he would get 50 billion out because it's all about who's there to absorb the selling pressure. It's all hypothetical net worth, okay? It's not money in the bank. So now back to Warren Buffett. Something spooked him. And to me, it's clear. It's this. It did not happen in 2008, okay? And none of these other recessions. On top of that, he has a indicator, Buffett indicator, market cap to GDP. It's now at the highest level in history, 200%. Before the GFC, it was at 105%. Before the dot-com bubble, it was at 138%. Before 1929, it was at 120, 130%. It's the most overvalued stock market in human history, suggesting that to get back to something like 2009 levels in regards to like a market decline, or rather what should be fair value, the market would have to decline about 75% from the peak, which would make it the worst decline since the Great Depression. That's his indicator, market cap to GDP. Okay. So now, let's go into what Milton Friedman and Steve Hanke, Milton Friedman, who is arguably the greatest economist of the 20th century, with his quantity theory of money. And what it states is that changes in the money supply have a effect only after a considerable lag. And I'm going to bring it up right now to you. Give me one sec. Friedman on the lag in effect of monetary policy. Friedman's argument on the policy lag has been only briefly stated and can be simply summarized as one second. There is much evidence that monetary changes have their effect only after a considerable lag, and that the lag is rather variable. In the National Bureau study on which I have been collaborating with Mrs. Schwartz, we have found that on the average of 18 cycles, peaks in the rate of change in the stock of money tend to precede peaks in general business by about 16 months, and troughs in the rate of change in the stock of money to precede troughs in general business by about 12 months. For individual cycles, the recorded lead has varied between 6 and 29 months at peaks and between 4 and 22 months at troughs. Or again, thus you have a situation, or wait, let's go to this sentence as well. Monetary fiscal policy is rather like a water tap that you turn on now and that then only starts to run 6, 9, 12, 16 months from now. It is because of this long lag in reaction to policy that you tend to have this tendency for policy to in fact have an effect opposite to that intended. Or again, thus you have a situation such that when the Federal Reserve System takes action today, that effect may of that action may on some occasions be felt 5 months from now, on other occasions 10 months from now, on other occasions 2 years from now. That is the major reason why it is so difficult as a technical matter in the present state of our knowledge to know what measures one ought to take at any given time. Now, in regards to the quantitative theory of money, I'm not going to go through this, but I have most of my knowledge comes from Professor Steve Hanke, who is a professor, um, in, an expert in applied economics, and he's a professor at Johns Hopkins University. And the second person I've learned from is Campbell Harvey, who is a professor at Duke University. Steve Hanke, I've learned about the quantitative theory of money from. And again, that's what this is about. So if you want to read this, I'm going to leave this in the description, but I'm not going to go through it because there's a lot in here. Okay. But basically, what it states, it states the lag effects, and they've taken multiple countries during this study where they were looking at the lags between changes in the money supply and how long it took for it to affect the real economy. And this is what I brought up before. If I open the M2 money supply chart, and then we put percent change from a year ago. Also, let me make this more visible for you. As I've stated before, in February of 2021, the money supply growth was 26.7%, but where was the inflation rate in February of 2021? Inflation rate. Inflation year-over-year US trading economics. Here. The inflation rate was 1.7% when the M2 money supply was 26.7%. Then we got this decline in the money supply, and with a lag, we got the peak in the inflation rate in mid 2022, but it kept soaring, right? And then we got this inflation right here. This inflation is still, you still have inflation, but it's going up at a slower pace, okay? And then we had this balancing out here, and now we're going down again. 20 months ago, we were in December of 2022, and we started going negative on this. The thing is, what did we see last month? Like I brought up multiple times now, we saw deflation for the first time since the pandemic. Deflation. For the first time since the pandemic. It did not happen here. It was flat. So deflation means that prices are falling, which in a modern economy is economic contraction. And this is what the central banks are not fighting inflation. Maybe right or recently they have, but long term they're fighting deflation. Again, Ben Bernanke, the Fed chair during the global financial crisis, deflation making sure it doesn't happen here. November 21st, 2002. Conclusion, sustained deflation can be highly destructive to modern economy and should be strongly resisted. If you want to read through this, I'm also going to leave this in the description. Okay. Now, what I mean by that is that, yes, they are trying to fight inflation, and you can even see it here by headlines like this. And there's FOMC meetings from 2018 where they're talking about how inflation has been running below 2% for too long, and they want it to run extra for a prolonged period of time to make up for all those years during QE1, 2, and 3, quantitative easing 1, 2, and 3, where they failed to reach their 2% inflation target goal over time. What is quantitative easing, which people deem to be money printing? The Federal Reserve creates bank reserves. Bank reserves is not money. They can make 5 quadrillion of them as long as as long as they don't buy anything with it, or as long as it doesn't make its way out into the real economy. Okay. Now, if they buy assets with it, and they're limited to what they're allowed to buy, right? Because of the Federal Reserve Act of 1913, which prohibits them from buying, for example, stocks currently. Now, they did go and buy corporate debt, and they broke that in 2020. And if you want to Google that, you can do that yourself as well. A list of 100 companies that from which the Federal Reserve bought corporate debt from, okay, during COVID. People just didn't care about it because the narrative was so strong and people didn't question anything because the virus was supposedly so serious, okay? But you can see here, Yellen's only regret as Fed chair, low inflation, December 13th, 2007. I mean, 2017. And she says here, we have a 2% symmetric inflation objective. For a number of years now, inflation has been running under 2%, and I consider an important priority to make sure that inflation doesn't chronically undershoot our 2% objective, she said. Okay? So they want inflation, we know that. They've been trying to cause inflation. So now, if we look at what's been happening, also going back real quick to quantitative easing, yeah, again, so they create bank reserves and they can buy treasuries and mortgage-backed securities with that of other banks' balance sheets or non-bank entities. The way they indirectly do money printing is they buy treasuries from you, okay? So if you get money for selling your treasury to the Federal Reserve, because again, they go out in the open market and they start buying treasuries, okay? Well, if they bought it from you, you now get money for it, which increases M2 money supply by the way it's defined, and that increases your, well, now you have more currency in it, and you may go and speculate with that money in, for example, stocks. And that's how it makes its way out into the stock market and then crypto, etc., right? Make sense? All right. So what's been happening in regards to the money supply contraction is due to quantitative tightening and money leaving the banking system. So quantitative tightening would be in reverse, okay? And by quantitative tightening, I'm talking about their balance sheet, okay? So this is the balance sheet of the Federal Reserve. It's gone from 8.965 trillion down to 7.1 trillion, okay? So about a 1.8 trillion dollar decline in their balance sheet. This has led to a money supply contraction because when this goes down, the money gets deleted out of existence. Okay? So that the liquidity that they injected into the economy is now being deleted out of existence. You might say that's a good thing. No, monetary contractions always leads to depressions. Now, this chart does not show us data going back to before the 1830s. And also it's a 6-month update. For example, if I look here and then I go to the right just slightly, this says July, December 1963, January, June 1964. So it would be 6-month updates. That's why it's actually not going to show every single contraction here if there is some in between here. So here's a better picture to tell us. When we look back at this chart showing the fastest money supply contraction since the 1930s, will be obvious what happens next. Historically, contraction coincided with bad outcomes. Why would this time be different? So you could say that in 48-49 there was a recession, and Warren Buffett was the adult at that point, but there was a severe recession there. 37-38, he was alive, but he was 7-8 years old because he was born in 1930. Great Depression. Then we had the Great Depression before that in 2021, 1913-14. 89, 93, 94, 65, 67, 73, 79, I forgot that one, 57, 1837. So we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 contractions. Now we're in the 11th. They have always resulted in either severe recessions or severe depressions. All had deflation, massive deflation, which we can see right here. When we look at the one going back to 1920-21, right? This one right here, okay? Look at what happened to the inflation rate. Up here, it was 23.7%. Down here, it was 15.8%. So in 12 months, from June 1920 until June 1921, the inflation rate went from 23.7% to 15.8% deflation due to a monetary contraction, and it led to a depression. So what does Warren Buffett know? Well, This is what Steve Hanke says. Okay, so I'm gonna get into this, and I feel like it's pretty important.
And the lag. Why is this so important? This is where people get messed up because they forget what's happening today is a result of something that happened to the money supply 20 months ago. So
Right there.
no one remembered. Number one, most people aren't at the Fed. They're not even looking at the money supply. But if you are looking at the money supply and think it's important, most people forget what was happening 20 months ago. So they're all confused. They look at daily data that are coming out. They're what's called data dependent. The Fed is data dependent. They look at the data coming out on interest rates, the stock market, all interest rate spreads, and all these other data sensitive things that are the result of changes that happened in the money supply a long time ago.
So that is December of 2022. Based off of the quantity theory of money, every single CPI reading. Now, let me be clear before I say this, okay? The government has an incentive to lie to you about the numbers. And am I a conspiracy theorist for saying that? No. Let's look at revisions if you want to do that. Because the US government, the Biden administration, I'm not political, but they keep revising numbers, okay? Look at what's happened with job openings. They have revised 14 of 17 months lower. I don't think that they're that stupid, okay? They also, even during the global financial crisis, they had a history of revising economic data. As you can see right here. You can see the department sharply revised its estimate for fourth quarter performance to show GDP contracted 0.2% rather than growing 0.6% as it's previously reported. Same thing in 2001. Q1 GDP first estimate was plus 2%, then it was revised to minus 1.3%. You can't miss that badly. Come on, man. So the reason why I'm bringing this up is because, again, what I'm about to say here, based off of this, and you should look at trueflation for the actual inflation rate. Based off of this, all of 2023's money supply contraction, which lasted from December of 2022 until March of 2024, should mean that ever since July of last year, we should see deflation, which we saw, going all the way until November to December. Where is it? November, December of 2025. Why? Because that would be 20 months out from this point. Puts you November of 2025. So the rest of 2024, all of 2025 should be deflationary, no matter what they do. It's like Steve Hanke says, it's baked into the cake, based off the quantity theory of money by Milton Friedman. So we're gonna see if it holds true. Now, again, I brought this up because even if this number does not go negative, they could be lying. And we have examples of it right here, and right here. Okay? Now, let's look at the unemployment rate, U6. And I want to be clear what this is compared to the national unemployment rate as well. Because this has been spiking now. U6 unemployment rate went up 0.4% in a month. That is really bad. It's up from 6.7% here, or 6.6% since the low of the cycle. Okay? Historically, recessions begin after 0.5%. What is U6? This is the actual unemployment rate, the way it was calculated before the mid-1990s, or early to mid-1990s. Because U6 counts everyone that is looking for a job. The national unemployment rate does not. If you are unemployed for 12 months or more, you drop out of the unemployment rate statistics. If you drive for Uber for 1 hour a week, you also drop out of the unemployment rate statistics. So you show up in U6 unemployment rate. U6 unemployment rate is the way the national unemployment rate was calculated before, or during the before it was removed in the early to mid 1990s. All right. One more thing. I wrote this down before, and I'm gonna write it down again. The year is 2007. The stock market, is at a all-time high. Yield curve the yield curve is re-steepening through a bull steepener out of inversion, like it always does. The unemployment rate is rising. Fed is about to cut September 18th. They cut September 18th, 2007, and they're about to cut September 18th this year as well. You check the current calendar date, everything is the same. So this goes into the yield curve inventors statement right here. It is deja vu. And again, this is the Campbell Harvey. He is the inventor of the yield curve inversion indicator, or he discovered its predictive power. It's deja vu. On August 7, 2007, with an inverted yield curve for 19 months and a cratering stock market, the FOMC decided to stay the course and keep the Fed funds rate at 5.25%. A brutal recession officially started a few months later. The most consequential piece of information for the Fed's decisions is the jobs report. Yes, inflation is also important, but inflation is easy to observe in real time. The FOMC statement is July 31st, 2024. On August 2nd, 2024, we got the jobs report. Why couldn't the Fed have pushed their meeting forward by 2 days so they could develop policy based on the most current data? The economy does unfold according to the Fed's schedule. The Fed needs to be flexible. As a result, of this rigidity, we need to wait a month for action. An emergency meeting might fan the flames and create additional uncertainty. Indeed, we have seen this movie before. The minutes from the FOMC meeting of August 7th, 2007 state, although the downside risks to growth have increased somewhat, the committee's predominant policy concerns remains that the risk that inflation will fail to moderate as expected. Future policy adjustments will depend on the outlook for both inflation and economic growth, as implied by incoming information. They held the Fed funds rate at 5.25%. Sounds familiar? At the time of the meeting, the yield curve difference between the 10-year and the three-month yield has been inverted for 19 months. The stock market was down 7.7% from its peak on July 19, 2007. By the September 18, 2007 meeting, the Fed cut rates by 50 basis points. It was too late. They followed with additional cuts in October and December of 2007. The NBR dated the business cycle peak recession beginning as December 2007, but they told you that in December 2008. Okay, I can bring that up as well. It was right here. Gonna get back to this article in a sec. December 1st, 2008. This is NBR. They defined recessions. They decided the month of the peak. The committee identified December 2007 as the peak month after determining that the subsequent decline in economic activity was large enough to qualify as a recession. This is an email I received a few years ago from the Fed economist who remains anonymous. The Fed, mainly the economist at the Federal Reserve, mistakenly dismissed the yield curve inversion in 2006. What is he citing when he's talking about that? Well, I'll bring that up as well. Give me a sec. If I can find it. I don't know if I'm going to be able to find it. Give me a moment. Yield curve 2006. Here, found it. Cleveland Fed. This was published on the 15th of April 2006. Does the yield curve signal recession? Experience has taught economic forecasters to expect a recession when the yield on the short-term treasury securities rise above the yield on long-term securities, a situation known as the yield curve inversion. Jerome Powell is also dismissing this now. He says it's wrong, even though it's playing out the exact same way. The unemployment rate is rising. It's re-steepening to a bull steepener, meaning the front end of the yield curve is declining faster than the long end of the yield curve. That means the hard landing, right? And you might say, oh, well, lower interest is bullish. No, it's not. It's bad because, again, it's not about the price of the money. It's about who lends that money, the banks. Okay, are they going to lend into a risk environment? No. How do we know that? Well, just look at how they're lending or what they're doing with their money. Instead, they're buying the long end of the yield curve and therefore contributing towards the yield curve inversion, just like Warren Buffett. Anyways, but some economists suspect that the yield curve might not be as reliable of a predictor for output growth as it used to be. 15th of April 2006, and this is what he's citing right here when he's talking about this. They mistakenly dismissed the yield curve inversion in 2006. That was when I read your paper for the first time. I've been a fan of your paper since then, but the board dominated the view in the Fed system at the time. The Fed dismissed the market signal about recession and kept the target rate for another whole year at 5.25% until the fall of 2007, a clear mistake in retrospect. The increased uncertainty reinforces slower growth. Consumers who hold back on discretionary spending. What CEO in their right mind would pull the trigger on a major debt-financed investment project today? Slower consumption and investment growth translate into slower GDP growth. Further, on the fiscal side, there's not a lot of dry powder if a major problem arises. The government has run $9 trillion of deficits in the last 4 years, including the most recent $1.7 trillion deficit. Interest on the debt is now shockingly more than the national defense expenditures. This limits fiscal flexibility and further increases uncertainty. Have you seen this movie before? On the left side, you have the Great Recession, how they raise rates, and they pause, and then they drop, and the recession begins. The yield curve was inverted for 19 months. Same thing here. They raise rates, then they pause. And then the yield curve has been inverted for 19 months. It's quite literally the exact same. This is what's so dangerous. And I believe that Warren Buffett got out of the market because he knows that a Great Depression is coming based off of history with money supply contractions. And if you think that he thought 2008 was bad, which he did, again, I'm going to bring up the documentary. Give me one sec. I'm going to try and find this. Give me one sec. Okay, obviously not going to watch the whole thing. For some reason, this is now unlisted. It's a great documentary. It has 17 million views. I'm gonna try and find it where he talks about it. Should be right around here. Yeah, here.
On Bank of America to roll their paper, and they're worried the Bank of America is not going to do it.
The markets were affecting the real economy. The markets were closing down, people cutting back hiring, cutting back investing, cutting back spending to protect themselves, and you were looking at what looked like could be a Great Depression.
I describe it as an economic Pearl Harbor. The 1929 panic was nothing like this. The system had stopped.
Did he sell back then? Nope. Did he sell now? Yes. Well, you heard what he thought about 2008. That's all for this video. Take care. Peace.